YouTube has some great content creators covering the benefits of investing in exchange-traded funds or ETFs. My channel's different. I look at the performance of 500 ETFs year to date. Hi, I'm Mark and you're watching Mark Talks Markets. Unlike the content creators at the beginning of this clip, I don't have a crystal ball to be able to predict the top 5 ETFs. And I've grown increasingly frustrated with the ease at which you can compare ETFs across asset classes, geographies, sectors and providers. So I built a database. Each day my sausage machine compares the performance of ETFs from providers including iShares, VanEck, Amundi and WisdomTree. Now we all know that past performance is no guide to the future, but for many people, past performance is a starting point. I've broken this show down into the 8 topics on screen and added chapter markers for quick reference. My aim at the end of this show is to give you a good overview of the top and bottom performers in the ETF market. So let's start the show with an overview of global markets. Both Nasdaq and S&P 500 are up 4% in the week ending the 24th of January 2025. The standout gainers are the European large cap stocks, with the Euro Stoxx 50 rising 7%. Two factors seem to be at play. Firstly, EU interest rates are likely to be cut in 2025, and Trump tariff policies may not hit Europe as hard as expected. There seems to be a perception in the markets that the major US tech stocks are looking expensive, and any sell-off in the US tech stocks is likely to see capital allocated to Europe, where stocks trade at lower valuations. The Nikkei had a poor start to January but turned positive in the week ending January the 23rd. Turning to the major currency movements against the British pound. I'm going to spend a little longer on currency than I ordinarily would and use the time as a reminder about the importance of currency to ETF valuation. Year to date, there's been very little movement in the US dollar and a continuous strengthening in the euro against the British pound. Take a position in the major currencies using the ticker symbols on screen, where GBUS is long the US dollar and USGB is short the dollar. Long dollar means we are positive about the prospects for the dollar, i.e. £1 will buy you more US dollars. Secondly, and perhaps more importantly, many of the ETFs that we're about to talk about stipulate a base currency. This allows investors to position themselves to benefit from currency movement, as well as the price in the bond or equity underlying the ETF. Currency can be a major factor in the selection of ETF. The key driver of currency movements is relative interest rates between countries. There is significant uncertainty around the direction of travel for US interest rate. The UK and Europe seem to be intent on reducing interest rates in 2025 to stimulate demand. Bitcoin is up 12.6%. Now, I don't cover cryptos because there are no crypto ETFs in the UK at present. However, as we shall see shortly, the crypto-related equity ETFs are prominent in the tables and are only likely to get stronger in the coming weeks as Trump introduces policies which are favourable to the US crypto industry. Next up is commodities. Palladium is leading, up almost 10% since January the 1st, with silver and gold close behind, with gains nearing 7%. Platinum is lagging. Palladium is pushing higher due to the prospect for further sanctions on Russia by the US. Russia is a major exporter of palladium. The demand for palladium is declining with the move away from the use of catalytic converters in cars. This might be a short-term price hike without continued momentum. Gold and silver have been on an upward trend for 2 years now, and that trend looks set to continue, driven primarily by the safe haven status of precious metals in times of political uncertainty. Note AIGI, a basket of industrial metals comprising of copper, aluminium, zinc and lead, is in position 16. I hold AIGI in my portfolio and have done for some time. I'm currently sitting on a small loss but will continue to hold given the potential demand for industrial metal to rise due to increasing demand in the nuclear and electrical industries. Think about the demand for lead in the nuclear industry and the copper and cables to transfer energy from nuclear power plants to AI data centers, which are energy intensive. Falling interest rates helps the price of metals, and as we said earlier, we're likely to see interest rates reduce in the UK and Europe, and possibly the US. The only faller in the table is the Wisdom Tree Zinc ETF. The only comment I can really pass on zinc is that the market is currently oversupplied. The option ETFs in the table are all provided by Global X. XYLP and QYLP at the bottom of the table are both covered calls on the S&P 500 and the Nasdaq. They've featured in my portfolio since Q4 of last year. I've been able to purchase both through Hargreaves Lansdown. Note the D at the end of the title for distributing. XYLP and QYLP both pay a monthly dividend. Yes, a monthly dividend, and are currently yielding 9% and 12% per year. The year-to-date gain in the table reflects the price movement only. The covered call should perform well if the Nasdaq and S&P 500 remain relatively flat. You can expect price volatility if either of those two indexes moves significantly from your entry point. When the dividend is factored in, all of the ETFs in the table are yielding about 3% year to date, except for the quarter tails, which I've highlighted in green. However, I've had trouble purchasing these ETFs through Hargreaves Lansdown. Let me know in the comments if you've been able to acquire those ETFs. So the next thing to talk about is Bond ETFs. Emerging market local bonds and high yield corporate bonds take the top two positions in the table. This is unsurprising given they represent the riskier end of the bond market and carry the highest yields. The emerging market bonds in the table accumulate dividends as denoted by A at the end of the title. Euro-denominated bonds fill positions 3 to 10 in the table. Hey, remember the currency slide from earlier? The gain in the euro bonds is broadly equivalent to the FX movement between the British pound and the euro. The third ETF in the table is a basket of high-yield US dollar corporate bonds. It is a distributor of dividends as denoted by D at the end of the title and is currently paying 6.23% per annum with the next dividend due in May 2025. In the middle of the table we see short-dated treasury bonds, short-duration corporate bonds and inflation-linked bonds. This is because there is an expectation that the European Central Bank will cut interest rates in early 2025. Falling interest rates are good for bond prices. Bond prices rise when interest rates fall. My interpretation of the above is that investors are quite uncertain about the future direction of interest rates in the US following Trump's inauguration. Some Trump policies may prove to be inflationary. It is therefore safer to hold short duration bonds and higher yielding corporate bonds until the interest rate environment becomes more certain. Turning now to look at the bond fallers. The table is dominated by GBP sterling denominated bonds. And that's really driven by the weak state of the UK finances following the recent budget. We also see that the long-dated US bonds are at the bottom of the table. And that's because of the continued possibility for interest rates to rise in the US if inflationary policies prevail. I'm new to YouTube. If you like what you've seen today, please hit like and subscribe. Bonds and equities may not be the most exciting of asset classes. However, they are where investors head to when the equity markets turn to. So it's important to be aware of those ETFs we can turn to when the equity markets aren't behaving as we would like. So that said, let's spend the next few minutes reviewing the equity market ETFs. I'm going to start by looking at the top performing equities in the S&P 500, the FTSE 100, the FTSE 250 and the Eurostoxx 50 indexes. I exclude the Nasdaq constituents from the database, there's just too many to keep track of. The top performing equity is Constellation Energy, US utility company operating nuclear power plant. The rise in the share price is really driven by optimism around artificial intelligence. Constellation is recommissioning nuclear power plants to meet the power demands of AI data centers. It's also had some recent M&A activity in recent weeks as it scales up in anticipation of infrastructure spending from the Trump administration. You get exposure to Constellation Energy, ticker CEG, using iShares Utility 500 sector ETF, where Constellation is weighted at 6.5%. I'm not going to focus on individual stocks in the table. Instead, I'm going to make some comments about sectors and markets. The first thing to note is that I am surprised that there are so many FTSE 250 stocks in the top performer list. Close Brothers and Burberry are both turnaround situations and have suffered in 2024. 4 sectors feature in the table. The electronic sector, in my view, is benefiting from the potential expenditure from the AI data boom. Oil and gas is rising on the back of Trump's comments around drill, baby, drill, and the removal of some of the green policy initiatives of the previous administration. I think the rise in the oil and gas industry will be short-lived, given the contradiction created by Trump in respect of asking Saudi Arabia to increase output to reduce prices, to put additional pressure on the Russian economy. Finally, semiconductors appear in the table 3 times on the back of the AI growth story. Let's take a look now at those stocks which fell in the year to date. Looking at the fallers helps us to understand which sectors and markets to avoid adding to our portfolio. No sector stands out to me. Stocks in the FTSE 250 regularly occupy positions in the table. FTSE 250 is an index which represents domestically focused UK stock, whereas the FTSE 100 is comprised of large international stocks. The other observation I would make is that there are no Euro Stoxx 50 in the bottom performing table. The key message here is avoid the FTSE 250 for the foreseeable future. So that said, let's take a deeper dive into the European market. At the top spot amongst the European large caps goes to Germany's Deutsche Bank. My second observation is the number of banking stocks in the top performing table. European banks are riding high, driven by the expectation for interest rate cuts in the near future. This will stimulate demand in the Eurozone and make credit conditions easier for European lenders. There may also be an element of M&A activity which hasn't been present in the European market for many years. The final point to call out is aerospace and defence. The war in Ukraine and Trump demands for increased defence spending by European NATO partners is likely to be a positive for companies like Airbus and Safran. There are very few fallers in the Euro Stoxx 50. Nothing to call out here really. Other than that, the European market certainly looks an encouraging place to invest in January. Strong gains across all major sectors and no large cap stocks posting significant losses. We began the show with a look at the movement in the major world indices. Euro Stoxx 50 was the standout gainer, posting a return of 7% year to date. Let's drill a little deeper and look at ETFs that are focused on countries. You can see that iShares and Amundi are the 2 dominant providers for those seeking exposure to countries. Poland takes the top spot with a gain of 12%, followed by the French CAC 40 and the German DAX. Surprisingly, Brazil and Mexico take positions 4 and 5. Trump's threats around tariffs on Latin American neighbours don't appear to be impacting those stock markets. Maybe there's a belief that tariffs will be watered down or are just rhetoric. At the bottom of the table is the FTSE 250, which is posting a small loss for the year. And finally, we have the Equity ETF risers. You can feel my excitement after 11 minutes. Taking the table from bottom to top, I will pull out some of the themes that we've observed from earlier in the show. In position 22 and 23, we have the Latin American focused ETFs from iShares. In position 20, we have a thematic ETF focused on EU financials. Recall we saw the banks feature heavily in the EU Stoxx 50 riser table. At position 17, we have a fund tracking the EU Stoxx 50 index. In the middle of the table, at positions 9, 11 and 12, we have country ETFs focused on Korea, France and Germany. Korea sold off at the end of 2024 due to political tensions and is now recovering lost ground. These are eclipsed by a Poland-focused ETF at position 5. We have several thematic ETFs taking the top spots. In position 7, we have an ETF focused on space travel. Trump and Musk both want to travel to Mars, and the US space industry is happy to profit from taking them there. In position 2, we have a gold mining ETF posting a return of 13%. Remember our commodities slide. Physical gold only returned 7%. It can be preferable to hold the gold miner rather than the physical gold ETF. In positions 3 and 8, we have 2 ETFs focused on the nuclear industry and the uranium commodity, which powers nuclear reactors. Going back to our top equity, Constellation Energy. More nuclear reactors means more demand for nuclear parts and uranium to fill the reactors. Positions 1 and 4 go to crypto ETFs. The return on the VanEck Crypto and Bitcoin ETF in position 1 is 16%, which exceeds the return on Bitcoin, which is 12% year to date. In position 4 is the Invesco Blockchain ETF, ticker BCHS. The return on BCHS is 12% versus 16% for VanEck DAGB in position 1. This proves that not all ETFs are created equal, and you really need to do your research and compare investment performance. If you've enjoyed watching today, please hit like and subscribe to be notified of the next show.